Join us for the first time. Thanks for coming by and checking out the Market Chameleon pre-market show with this man, Dimitri Kargamonic. How you doing, D?
Good morning, everyone. Welcome. Before we get started, keep in mind, Will and I and Market Chameleon, we're not a registered investment advisor. We're not a broker-dealer. We're not telling you what to do. We're just sharing ideas. If you need advice, call your registered investment advisor. Call your broker. That's what they're there for.
Excellent.
And I'm going to share my screen as we get started. If you guys are joining us for the first time, Will and I, we do these shows in the morning to try to help answer questions you may have about the Market Chameleon tools, the data, analytics. If you have a question, type it into the live chat on YouTube. Will's watching it. He'll read it back to me. To give you guys a couple minutes to type in those questions. In the meantime, what we'll do is start out taking a look at the pre-market report, see if we could get insights, what's trading in pre-market hours, and then we'll move on to the questions. Okay.
Awesome.
So pre-market report. These are stocks trading today in pre-market hours. We do have this calendar view that allows you to go back in time, back date, see what happened in the pre-market hours on a specific date. Right now, we're on November 24th. And here we see there are 352 stocks so far that traded higher in the pre-market hours, 218 stocks trading lower. As far as volume, we got 81 million shares trading on up volume versus 34.9 million shares trading on down volume. If we convert that stock to dollar value, we got $581 million worth of stock trading higher versus $1.4 billion worth of stock trading lower. So kind of a mixed bag. More stocks trading higher, but if we look at the dollar value of all the stocks, more of the dollar value trading lower. Let's look at it from a couple more angles, and then we'll move on to the questions. I'm going to come down here. We have a list of our most active stocks, our biggest percentage gainers, biggest percentage decliners in the pre-market. We have 34 stocks that made our biggest percentage gainers list, 13 on the decliners. So from there, looks like a little bit more bullish trading in the pre-market hours. If we look at this list, there are small cap stocks in there. We do have ETFs in there, some leverage products, could be a closed-end fund. So pretty much any security, if it's listed on a major U.S. exchange, it's trading in the pre-market hours and meets the thresholds that we set for liquidity, price change, volume, it could make this list. And to narrow it down to a smaller group of stocks, we could use the filters above. Up here, if you have a watch list, you could filter by your watch list. We're going to use this one, an ETF. So we can click on that filter, we get a drop-down menu to select from different ETFs. We're going to take this one, SPY. Click on that, and when you do that, the list below gets filtered by stocks that are holdings in the SPY ETF. So far, only one stock that met our biggest percentage gainer threshold made the list, non-decliners. So there are stocks trading in pre-market hours, but only one kind of breached that level to, make it a significant enough gainer. Again, today is a slow day, right? I think it's what time does the market close today? It's like a half a day.
Yeah, I think it's one.
Yeah, day after Thanksgiving. It looks like a mixed bag here. Neither overwhelmingly bullish or bearish. That's pretty much that for the pre-market. If you have questions, I'll take them now.
Nothing's popped up yet, D.
Okay.
We are on a little bit of a delay.
Okay. So what I'll do is maybe take a couple minutes. Let's go to the SPY just to give you guys some It's kind of my default symbol while we're waiting for questions to come in. And let's take a look at, I'll kind of follow up on the previous request to look at the options chain, set up different strategies. So the benefit of options is that you could really use a combination of options to create strategies based on different outlooks, right? On the stock, on the volatility, even interest rates, dividends. So constructing them is, you know, is a really big value if you know how to do it and what to do. You know, we talked about there are ways to just trade volatility. There are ways, you know, to trade direction, trade ranges, and all, you know, all that stuff. So we try to sometimes just come out and talk about some different common strategies that people use out there. So let's construct maybe, you know, unless if you don't have a request, I'll just pick one, you know, just kind of pick one out. There's a common one, might be a let me see, what about a risk reversal, right? So risk reversal would be when you do call and a put on different strikes, right? And usually you'd have a directional bias, or you could trade it even delta neutral if you hedge it with stock. But with a risk reversal, we'll put one up and just see what that looks like. So let's do one with a bullish bias. And the idea there is you buy a option, a call to the upside. So I'm going to go up here, go up a couple strikes, 460. Let's say we purchased that call. So that will be the first leg. And of course, if you're buying an out of the money call, and you're holding it, then you have a bullish outlook. You're hoping that that stock will go up and through that strike. Now, if you're that very bullish, or you think maybe you'll sit here in this range, not fall too much, then the risk reversal lets you just sell an out of the money put to help finance some of that call premium, or maybe the total call premium. So let's go down from 455, right? That's where it is. Let's go down 1%. So if you hover over, let's go to the 450 strike, or let's go to the 451 strike. Okay, so I'm going to sell this for 78 cents. So here's what the risk reversal looks like. We're buying in November 30th, one call for 460, 65 cents, selling the November 451 put for 78 cents. So when we calculate that, then you could see here, this is a credit of 13 cents. So what happens is that you paid 65 cents, received 78 cents, then you've received the credit for doing that trade. And here below, this is what your risk profile looks like at expiration. So you could see here's the spot price right there, right now, 455. That's the middle line. And if the stock, right, closes anywhere in between these strikes, right, the 460, 451, anywhere in between these strikes, both of these options will expire worthless, right? The call goes away, the put goes away based on the strikes that you pick. They expire worthless. So anywhere there at expiration, once they expire worthless, since you got a credit for this spread, initially, we know we sold it, let's say over here somewhere. Since you got a credit, basically you got to keep that credit. And after expiration, the options are gone, and that's it. So what's the outlook here? Well, the way we structured it is that we really wanted to go above that 460 strike. Because at that point, right, it goes 1-for-1 with the stock, and you could see that's a bullish play. And of course, if it goes down through the put, then you're losing 1-for-1 with the stock, right? That's the risk of this strategy, right? The risk and the reward of the strategy. And you could see it has a delta, right? So this is the delta, the initial delta and gamma of the strategy. So that's the risk reversal. And when you structure it from here, you can just add more legs to the strategy, right? It doesn't have to, we could do whatever we want. We could buy a ratio, buy 2 calls, sell 1 put, or we could protect ourselves by buying a put below. If we're afraid that if we're wrong and it really falls, we stop ourselves out. So it doesn't have to stop there, right? You could continue to change this strategy around from your starting point. So let's say that this looks good to us, but I don't, if the stock continues to fall, I want to stop myself out somewhere. And, from 451, maybe you think it's gonna, if it goes down, it doesn't go down that much. It's slow, but if it gets to, like, say 440, then it's just going to drop. Your opinion is, at that point, I want out. Something is wrong. If it's dropping that hard, then it might drop really hard. Maybe it's a money panic. Something's going on. So you could just go and then see, well, what if I stop myself out at 440? So we're buying that put, right? So now we got the same strategy, except we added the 440 put to stop ourselves out. Calculate that. So now that's what this looks like. So looking at the strategy, if the stock closes anywhere between these 2 strikes, 460, 451, same thing, all these options are shorts or long, all of them expire worthless, right? Because the call is out of the money, the puts are out of the money, they all expire worthless. And at that point, we still see that there's a small credit here, right? Like anywhere between 2 to 5 cents is where the market closed out. So it's not so bad if it just sits there. Let's say it's a break even at that point. Now, if it goes up and goes up through our long strike, well, then we're making 1-for-1 with the stock, and really at this point there's no cap how high it could go, right? Because we have a call, we didn't sell any calls above that. So at that point, if you're looking at it, then the higher goes, the better. But now to the downside, we still have that risk. We did originally the risk reversal. What is your risk of the stock dropping? This is of a bullish nature, this strategy. If it goes below that strike, that 440 strike, that's when you start losing. But what we did here was buy that put on the 440 strike. And now you could see here, what we did was stop ourselves out to the downside, right? So at least the risk to the downside now is capped somewhere, right? So it looks like it's capped at $1,000 or whatever that is over here. So that's what we did, and we could continue, adding to that strategy. We could say, well, maybe I want to lift this area here a little bit, and maybe, it's not realistic that it's going to go to infinity. So at some point, I believe that it will stop. So it could add another leg to it. And let's say we sell another call. So here where it's, well, at that point, there's no calls to sell. It looks to me like there's no more premium in these. So it wouldn't make sense to sell this for a penny, or, you probably won't even make up for commission. So at that point here, that's somewhere perhaps to stop. And this original one, this original risk reversal, the way I started it out was kind of just centered it around the at the money, right? Where the spot price is. But we could shift it up or down. So I'm going to let's do this. Let's shift this whole thing down some strikes. And I'm going to do that by over here. So instead of choosing new strikes, I'm going to click on that. And you can see it brought the strikes down one click. Let's do 2 clicks. So I brought all the strikes down. Now we're doing different strikes. We're buying the 458 call, selling the 449 put, buying the 420 put. Okay. Let me see why it shifted that much. Okay. The reason it shifted down so much is that you could see to the downside, we don't have any more dollar strikes. So you could see then all of a sudden the ones available are $10 apart. But let's just see what that looks like. So I'm going to rerun this strategy and see what the payout diagram then looks like, because now we kind of shifted the entire thing down a little bit, right? Because we're nervous to the downside. So recalculate that. Let me see how. Okay, so now what happened was that I think the problem is that, yeah, I think the problem is that put really dropped. So let's go the other way. Let me see. I'm going to shift it up. I think the problem is that the available puts to the downside are just too wide apart. So let's shift it up, see how that looks. All right, so now here we shifted this up. I'm going to go 10% around. So you could see now we received the bigger credit, right? So at this point, if the stock closes anywhere between, let me see, the 480 and 453, we received the bigger credit at that point. So to the downside, we start losing, because now we shifted it up. To the downside, we start losing a little bit earlier. So this is a more bullish play. I went the other way. So, below the 453 strike is where we start, this put goes into money. But we do stop ourselves out earlier at 442. Okay. And you can see here that what we did here by doing this, what we gained was a bigger credit from the get-go. So instead of receiving, I think it was like 2 cents or 3 cents, now we're getting a bigger credit. So here the outlook changed the following, that we think that the stock is most likely going to either sit here, drift a little bit higher. So it's between sitting here, drifting a little bit higher. So we don't think it's going to drift this high. But if it does go if there's a bullish, there's more likely maybe a bigger bullish case than a bearish case, and that if it's very bullish, it could explode to the upside. Right. So if it drifts higher, it's not going to drift too much, right? Because otherwise we'd want to shift this lower. And if there's a bullish case, like say the interest rates come down and we rally 10% or something like that, then this would be something that's consistent with that outlook. And to the downside, we stop ourselves out earlier. So you can see all I did was just took the previous strategy and moved all the strikes to see how that changed that payout diagram. So I guess, Will, if there are no questions, I might just end it there. So
we did have one question. Rob was asking, do brokers require a cash guarantee on the sale of the put in this trade? I guess it would depend on the broker, right?
Yeah, that you'd have to, right. So I wouldn't be able to answer that question. It would depend on the broker and what type of an account you have approved with that broker. So I think that, that could vary from broker to broker and from even one account to a different account. So some people have an account that allows for higher margin, for allow, you could even write more puts, but I think it will depend on the broker and the individual account.
Perfect. So that was the only question. Outstanding. We're right up against the opening bell. Awesome job, buddy. Remember, everyone, it's a half day. The market closes at 1 today. So a good day to be light on the trading side and relax from that large Thanksgiving meal. Awesome job, D.
All right. Thanks, everyone, for joining. Stay safe out there. Have a great trading day. Have a great weekend. Hope to see you guys on Monday.